Most people think markets break when earnings disappoint. That is amateur thinking. Markets break when the plumbing changes. I do not mean the headlines you watch, the speeches you quote, or the clever little charts that make frightened people feel informed. I mean the invisible pipes that move liquidity, trust, collateral, refinancing, reserve demand, and political power through the financial system. When those pipes widen, nearly everyone looks smarter than they are. When those pipes narrow, intelligence suddenly stops helping people who built their lives on cheap money. And right now, the plumbing is changing. If you keep looking at the wallpaper while the water pressure is dropping, you are going to misread the whole house. For decades, the global house was simple. The dollar was the main pipe. Treasuries were the pressure tank. American capital markets were the deepest basin on earth. If money got nervous anywhere, it usually ran back into the same place. That system made Americans richer than they understood. And it let investors mistake a structural privilege for personal genius. That is what easy eras do. They turn a favorable pipe layout into a morality story. People start telling themselves that America wins because it deserves to win, that valuations stay high because quality always gets rewarded, that the Federal Reserve can always reopen the valve, that the rest of the world has no choice but to keep funding the machine exactly the way it has for 30 years. That is the lullaby. I have lived long enough to know that what ruins people is not usually the danger they can see. It is the danger hidden inside an old assumption that used to be true. The old assumption was this: the rest of the world would keep treating dollar reserves as untouchable, Treasury demand as automatic, globalization as permanent, and U.S. financial assets as the default destination for fear. Now ask yourself a harder question: what happens if one of the largest players on earth decides those pipes are no longer safe for them? That is the real story. Most investors are still staring at tariffs, speeches, export controls, campaign slogans, and diplomatic theater. They think this is a noisy geopolitical argument. They are missing the deeper move. China is not merely arguing with the United States. China is redesigning its exposure to the dollar plumbing itself. That is not a headline, that is a structural act. And structural acts do not ring bells before they matter. They accumulate, they look incremental, they bore people. Then one day the market suddenly treats them as obvious, and by then the prices have already moved. You need to understand what that means in plain language. For a long time, China parked an enormous amount of national strength inside a system controlled by someone else. Export earnings flowed into dollar assets. Treasury securities served as reserve storage. Access to the global settlement system was part of the bargain. It made sense while the world looked stable and while the implicit promise behind those reserves still held. Then Russia showed every major power on earth what can happen when reserves become political. That was not a Russian lesson. That was a lesson to every country watching. The message was brutal. Assets you think are reserves can become hostages if the wrong sovereign controls the lock. Once you understand that, you stop looking at reserve management as a question of yield. You start looking at it as a question of survivability. That is why I want you to throw away the childish conversation about whether some central bank buying gold is bullish for gold next quarter. That is not the level to think on. If a great power shifts even a portion of its reserves away from assets that can be frozen and toward assets that cannot be politically seized, that is not a trade, that is national balance sheet armor. I call that mechanism hostage reserve risk. And once a country sees it clearly, the direction of travel changes even if the speed looks slow. Gold matters in that world for a simple reason. It sits outside another politician's permission structure. Bilateral currency agreements matter because they reduce dependence on the old pipes. Parallel settlement rails matter because no serious power wants a single foreign valve sitting over its oxygen line. Individually, each move looks manageable. Together, they form a rerouting project. That is what the market still does not respect. People keep asking the wrong question. They ask, does this dethrone the dollar tomorrow? That question is useless. The question that matters is the structural bid for the old pipe strengthening or weakening over time? If it is weakening, then every asset priced on the assumption of endless cheap and eager dollar demand must eventually answer to that reality. You do not need a Hollywood collapse for this to matter. You only need a lower quality of support. That is enough. American markets have been fed for years by a quiet privilege many investors never bothered to name. The world helped finance U.S. deficits, absorb Treasury issuance, and reinforced the perception that dollar assets deserve premium treatment. That hidden subsidy kept more things elevated than people realize. It helped keep borrowing cheaper. It helped support higher multiples. It made policy mistakes less expensive than they otherwise would have been. Now, put that beside the current facts. The United States is issuing enormous quantities of debt. One of the largest foreign buyers has strategic reasons to reduce dependence, and investors still talk as if the pressure tank refills itself by magic. That is not analysis. That is faith disguised as sophistication. When supply rises and one important source of structural demand weakens, yields do not need a philosophy. They only need arithmetic. And when Treasury yields rise, they do not stay politely inside the Treasury market. They march through the whole valuation stack. Equities feel it. Corporate credit feels it. Real estate feels it. Private equity feels it. Any asset that relied on a lower discount rate starts discovering what gravity feels like when the pipe narrows. I want you to notice something else. This is not just an external story about China putting pressure on America. America spent a decade building fragility with its own hands. When money was practically free, corporations behaved exactly the way you should expect people to behave when the pain of tomorrow can be outsourced to the excitement of today. They borrowed heavily, they refinanced lazily, they assumed cheap capital was a permanent climate rather than a temporary season. Boards got flattered by rising multiples, sponsors got flattered by leverage math. Managers confused favorable financing with durable quality. That is what low rates do to character. They turn discipline into an optional feature. Now the bill is coming due not everywhere at once, not cleanly, not in a way television can summarize in one red banner. It comes through refinancing, it comes through maturity walls, it comes through an 8 or 9% rollover replacing a 4 or 5% fantasy. It comes through a company discovering that its business was never bad enough to die in a zero-rate world and never good enough to survive in an honest one. That is the refinancing trap, and the companies I worry about most are not the obvious giants everybody debates all day. They are the middle tier, big enough to have real debt, too small to have fortress balance sheets, large enough to have believed the cheap money era, weak enough to find out that belief was not a strategy. You will see them in commercial real estate, in retail, in media, in health services, in all the tired corners of the economy where margins were already thin and the interest line is now becoming predatory. This is how the plumbing breaks in the real world. A little more debt service here, a little weaker demand there, a little narrower margin, a little tighter lender attitude, a little wider spread, and then the whole thing stops being little. People love the phrase soft landing because it comforts them. It gives them the emotional benefit of realism without forcing them to abandon the upside. But soft landings are easiest to believe in when you ignore how feedback loops work. I want you to understand the doom loop in household language. A company refinances at a much higher rate. Its interest expense rises, its flexibility falls, hiring slows, investment slows, guidance weakens, credit investors notice first, so spreads widen. Now capital becomes more expensive, not only for the weak, but for everyone nearby. Equity investors finally notice multiples compress. Stocks fall, consumers feel less wealthy, spending softens, revenue weakens further. Then what looked like a rate problem becomes an earnings problem, then a labor problem, then a confidence problem, then a systemic problem, that is reflexivity in plain English. The pipe narrows, then fear itself becomes part of the narrowing. And now we come to the part most investors still do not want to hear. The Federal Reserve is not as free as people think. For 25 years, people were trained to believe in the rescue reflex. Markets wobble, the Fed cuts, liquidity floods back in, assets recover, and anyone who stayed bearish looks foolish. That conditioning became a kind of civic religion. It taught investors to treat every crack as temporary because the central bank would reopen the valve. But that playbook depends on one thing. Inflation must be tame enough for emergency easing to be painless. I do not believe that condition is secure. The headline numbers may cool for a while. That does not mean the system is clean. Deglobalization is inflationary. Rebuilt supply chains are inflationary. Permanent fiscal excess is inflationary. Energy transitions are inflationary. Political competition between great powers is inflationary because efficiency dies when nations start paying for redundancy, security, and strategic independence. You cannot reorder the world's industrial map and expect it to be cheap. So the Fed is caught in a more uncomfortable position than most investors appreciate. Cut too aggressively and risk reigniting the very fire you claim to have controlled, stay too tight, and allow credit stress to spread through a debt. Heavy system that is not omnipotence, that is constraint. I call this the broken rescue valve. And once investors realize the rescue valve is not as clean or as immediate as they imagined, they stop paying premium prices for hope. That is when repricing gets violent. Now let me turn back to China, because the China side of this story is not just about reserve diversification. China also carries its own internal strain, and that strain interacts with the world. A great many people still talk about China as if it can simply order recovery by decree. They talk about intervention, support packages, liquidity injections, policy tools. They speak as if scale automatically produces repair. That is not how damage psychology works. China's property system was not a side sector. It was a giant warehouse of household belief. Prices falling there do more than hurt developers. They damage confidence, they weaken local finances, they erode collateral assumptions, they make consumers more careful. And when a population with a wounded balance sheet becomes more cautious, the slowdown does not stay isolated. It leaks outward through commodities, trade flows, margins, supply chains, and pricing power across the world. So look at the perversity of the setup. China is strategically reducing dependence on the dollar system. At the same time, China's internal weakness exports deflationary and destabilizing pressure outward. At the same time, the United States needs massive debt financing and carries a debt-heavy corporate sector exposed to higher rates. At the same time, investors remain priced for a world in which the old plumbing still works. That is why I am uneasy. Not because I need drama, because I can count, and because I know what happens when several separate pipes all lose pressure at once. Most people will still miss it because they love stories with a single villain. But this kind of event never arrives as one clean cause. It arrives as several vulnerabilities deciding to cooperate. I want to take you one layer deeper because the technology war matters more than people admit. This is not just about semiconductors, tariffs, rare earths, and industrial bragging rights. It is about forced redundancy. When two large powers decide that mutual dependence is now a security risk, the cost structure of the entire system changes. Domestic replacement is expensive, duplicate supply chains are expensive, strategic stockpiles are expensive, onshoring and friendshoring are expensive, export controls are inflationary, counter controls are inflationary. National resilience is almost always bought with lower efficiency. Investors keep pretending this is temporary friction. I think it is permanent cost. And permanent cost means lower margins somewhere, larger deficits somewhere, and more pricing pressure somewhere. Again, the market keeps pricing a prettier world than the one being built. Now let me bring this home to you personally, because I do not care whether a theory is elegant if it does not change behavior. If you own assets simply because they went up in the old pipe layout, you are vulnerable. If you hold expensive growth because you assume rates will always rescue valuation, you are vulnerable. If you own heavily leveraged businesses because you confuse expansion with resilience, you are vulnerable. If you have no cash because idle money offends your ego, you are vulnerable. If you have never tested your portfolio against higher yields, weaker multiples, wider spreads, and a less generous Fed, then you are not investing. You are renting confidence from yesterday. That is the psychological damage of long, easy periods. They train people to treat preparedness as stupidity. The man with cash looks foolish while markets levitate. The investor demanding a margin of safety looks old. The buyer of gold looks dramatic. The seller of leverage looks timid. Every disciplined act gets socially taxed in a late cycle market. Then the cycle turns and all those insults change names. Cash becomes optionality, gold becomes insurance, patience becomes discipline, skepticism becomes wisdom, and the people who mock caution discover they were never brave. They were simply subsidized by favorable plumbing. I do not want you to miss the American household angle either. A lot of people hear a macro story and assume it lives on Bloomberg. It does not. If Treasury yields stay higher, mortgages stay harder, if refinancing costs rise, employers become less generous. If middle-tier companies crack, layoffs move beyond the obvious sectors. If equity multiples compress, retirement accounts stop feeling like protective blankets. If inflation remains sticky while growth slows, families get hit from both sides. The paycheck feels less secure and the dollar buys less. That is what a plumbing event does. It travels from sovereign balance sheets to boardrooms to payrolls to kitchen tables. By the time it reaches the kitchen table, the people who said it was just a macro concern are suddenly explaining why groceries, jobs, credit card rates, and home equity all feel worse at once. So what do I do with all of this? I do not panic. Panic is what people do when they waited too long to think. I prepare. Preparation is not glamour, it is structure. First, I respect liquidity, not theoretical liquidity, real liquidity, the kind you can actually use when prices are ugly, the kind that lets you buy instead of beg, the kind that keeps you from becoming a forced seller. People talk about cash as if it earns nothing. In a dislocation, cash earns courage. That is a tremendous return. Second, I respect real assets that sit outside the permission structure. Gold is not magic. It is not an ideology. It is simply one of the few financial lifeboats that does not depend on the solvency, honesty, or geopolitical kindness of another government. When nations start treating reserve architecture as a battlefield, I pay attention to the asset that does not care who wins the speech. Third, I get far more suspicious of leverage. When the refinancing pipe tightens, I do not need to be short everything to understand where fragility lives. Fragility lives where debt service assumed an old world. Fragility lives where duration is long and refinancing is near. Fragility lives where optimism is embedded in the capital structure itself. Fourth, I keep my eye on signals that matter more than headlines. Credit default swap spreads matter because credit people usually smell smoke before equity. People admit there is a fire Treasury auction demand matters because that is where the old pipe reveals whether its support is still automatic. Currency behavior matters because foreign pressure often shows up there before it appears in domestic talking points. Weak auctions, wider investment, grade spreads, disruptive moves in the yuan or the yen, those are not trivia. They are the sound of the pipes straining behind the walls. Fifth, I think independently. This sounds polite. It is not. Independent thought in markets is expensive. It requires you to look stupid before you look right. It requires you to give up the comfort of consensus. It requires you to hold a position without social proof. Most people cannot do it, which is precisely why major turning points keep humiliating crowds. I have seen that movie before. In every era, intelligent people become prisoners of the framework that made them successful. They do not fail because they are dumb. They fail because they keep using old plumbing maps after the building has been remodeled. That is what I think is happening. Now, the framework built on permanent dollar dominance, clean Fed rescue power, harmless deficits, benign globalization, and endlessly dependable foreign financing is aging rapidly. The world changing does not ask your permission. It simply starts charging different prices. I am not telling you certainty. I do not worship certainty. Certainty is often just ego wearing a tie. I am telling you probability. The probability distribution has shifted. The downside is fatter than the market is pricing. The old support beams are less reliable than investors believe, and the people still paying top dollar for assets as if none of that matters are not being brave. They are being complacent. I want to make one thing very clear. I am not calling for a theatrical apocalypse. I am calling for respect. I am calling for discipline. I am calling for an honest look at how quickly a financial system can move from apparently stable to suddenly punitive once enough assumptions are challenged at the same time. That is the pattern people always forget. Slow accumulation, then rapid resolution. If you wait for absolute clarity, the repricing will already be done. If you assume somebody else will ring the bell for you, you will learn that bells mostly ring for crowds, not for disciplined investors. And if you keep telling yourself that every threat is just another buying opportunity because that worked the last few times, you may discover that you are not studying principle at all. You are studying one favorable regime and mistaking it for a law of nature. Now, I want to bring Buffett's simplest lesson into a world that thinks in macro headlines. The purpose of capital is not to impress strangers. The purpose of capital is to increase your control over your future. That means surviving the tightening pipe. That means refusing to be a forced seller. That means owning enough liquidity and enough patience to act when fear finally produces mispricing. That means understanding the difference between a temporary, quote, decline in a good asset and a permanent impairment caused by a broken financing structure. That means refusing to let narrative momentum make the decision for you. There is another word for that: Refusal power when you have cash, low leverage, emotional control, and no urgent need to sell. You possess refusal power. You can refuse bad bids. You can refuse bad timing. You can refuse the social pressure to chase what everyone else is chasing. You can refuse to turn volatility into loss. Most people want higher returns because they think returns create freedom. Often the opposite is closer to the truth. Structure creates freedom first, then freedom lets you capture returns when other people are trapped. That is why this moment matters. If the world is moving into a period where reserve systems are being hardened, alliances are being repriced, supply chains are being duplicated, inflation is more stubborn than central bankers wish, deficits are larger than voters can tolerate, and refinancing risk is spreading through the middle of corporate America, then the investor who survives best will not be the loudest optimist or the cleverest doom merchant. It will be the investor with the best plumbing discipline, the one who knows where pressure is weakening, the one who knows which pipes are real and which are decorative, the one who keeps dry powder while other people keep slogans, the one who distinguishes between liquidity that is actually there and liquidity that disappears the moment everyone reaches for the door, the one who remembers that optionality is wealth, and above all, the one who does not let complacency make a life-changing decision in his place. So here is the personal test. If the Treasury market delivers a few weak auctions, if credit spreads start widening, if the middle tier of corporate America begins to crack, if the Fed sounds trapped, if China keeps rerouting reserves, if the currency market starts sending stress signals, what will you do? Will you still tell yourself it is noise because comfort is easier than analysis? Will you cling to expensive assets because selling would force you to admit you were relying on a pipe you never understood? Will you wait for television to bless what your own eyes should already be seeing? Or will you do what serious capital always does when the building changes? Will you step back from the wallpaper, study the plumbing, strengthen your balance sheet, protect your optionality, and prepare to move while everyone else is still arguing about whether the water on the floor means anything? That is the door in front of you. Not fear versus courage, not pessimism versus optimism, discipline versus complacency. I know which side I would rather own.